Silver's going to reprice itself into a new reality. I still think that we're going between 300 to 500. Gold did a similar thing. The March brief spike low, it fooled people, and I think we're now headed up to challenge the highs. Momentum says so. And I think price will become more evident in the coming week or two. Once we've cleared this clump of ink, and I don't mean you have to get back above 120, okay, and we're not going to go sideways for another 3 months or go down to $50 or whatever, all the commentators say. So that's our assessment of silver right now. Yeah, gold's important because it's the mama market, but we'll be silver and likely silver miners. When you look at a spread chart of Bloomberg versus the S&P, go back a couple decades, you look at the spread chart and think, what's it going to do, go to zero? Commodities going to go to zero? No, they're a major buy. They've been basing versus the stock market in terms of relative performance. The net trend of the commodity complex turned up in October, well before the war event, okay? Has the war gotten better since late March? No. And yet silver's back up to a level where it's sort of like if you shorted the war news, your best break even. Maybe you're losing.
And now you're calling for $300 silver this year. A lot of people are looking at the chart, seeing, we topped out at 120. Now we went pretty much half that and are concerned, we could trace back to 50 or whatnot. But you look at not just the price, but also the momentum. So can you share with our viewers what is telling you right now that silver could even go to $300 an ounce this year?
I think it'd go to $300 to $500 an ounce, possibly this summer. Okay. There's so many arguments for it. Price-based, monetary evaluation-based, archival-based of what some other markets have done under similar technical situations. And then when we look at our momentum analysis, now by momentum, I don't mean the stuff you see on your quote screen for free, like RSI or MACD. Those are generally short to intermediate term. And we look at structural action of momentum, meaning when we plot price, you see a structure, but when you plot momentum, often you'll see a subtly different structure. And usually when you get trend changes and dynamic, top or bottoms, momentum will lead the way. You'll see it break out first, and then price will suddenly get the message. Well, over the last couple of years, as silver was, we had that surge in 2020, which took silver up to 30. Again, that's not even the top of the multi-decade range, which was 50. Okay. Then you went sideways late 24 into early 25 at about $35.
Markets climbed, but underlying liquidity stress indicators moved the opposite direction again. According to Michael Oliver, momentum structures shifted before price confirmed the breakout narrative. Central banks kept accumulating bullion, while sovereign debt markets absorbed rising refinancing pressure beneath stable headline inflation data. Retail traders focused on chart volatility, while institutions quietly tracked deteriorating bond market confidence and currency stability. Retirement portfolios tied heavily to paper assets remain exposed if monetary liquidity escapes traditional debt markets. Next, Michael Oliver reveals why momentum broke before most investors recognized institutional repositioning.
In June of 2025, you came back up toward 35 again, and we announced, that's it, you're gone. You're going to blow out all the range highs, etc. And then some other technical events occurred in the process that argued long-term now, not ignoring the short-term stuff, that you're going a lot higher. Silver's going to reprice itself into a new reality. And I still think that we're going to that new reality range. I think it is between 300 to 500. And I think the only issue right now is, and I think we're answering it pretty much with our work, it says what we've seen over the last 3 months, Feb, March, April, now early May, is violent sideways. Yes, there was a what we could call a phantom high at 120. But the amount of time you were up there in that anywhere near that price was, hours or a few days, okay? It wasn't like you lived up there. So it really was a gaseous level, okay? And it collapsed in one day, January 31st. So really most of the collapse was a one-day phenomenon. And you followed through with a lower low into February 3rd on silver and gold. In silver case, it was about $66 was that low. Okay. And then since February, you've been in this violent up-down range until March. And then, of course, the headline guys came in. And, we have the war with Iran. Oh, my gosh, we're going into global depression, et cetera, because oil's going up.
This happened before prior commodity repricing cycles too, and the timing still matters most. Michael Oliver notes temporary collapses often appear just before structural momentum regimes permanently reset higher. Silver briefly touched extreme highs, reversed violently, then stabilized while geopolitical headlines distracted public attention from liquidity behavior. Policymakers discussed stability even as commodity volatility exposed underlying fragility across debt-sensitive financial markets and currencies. Savers reacting emotionally to headline swings risk missing the longer institutional transition already unfolding beneath surface pricing. Next, Michael Oliver exposes why violent reversals often precede sustained institutional commodity accumulation phases.
We had to sell silver, okay. And we suggested in a report prior to that late March 23rd sell-off in silver and gold that they would go down and nip out the February price low, something that every guy looking at a price chart could see that, no, the silver low is 66. If it ever takes that out, it's all over, okay. Well, in March 23rd, you went down to about $61. And if you'll examine the daily action of silver at that point, it's quite phenomenal. You spike below that February low, no doubt running the stops. Gold did a similar thing. And silver spent about 2 hours below the Feb low and then $10 rally right bucket out of the hole. Okay. And now, of course, we're trading $20 higher than that March 23rd low. And this recovery that we've recently seen since late March, we have measured the action. If you look at a price chart, you'd say, well, it's just another rally in the range. But momentum says, no. Shorter term, intermediate momentum says, no, you've come out of the hole now. You're on your way back up. And so we argue right now that that was it. The March brief spike low. It fooled people. And I think we're now headed up to challenge the highs. Momentum says so. And I think price will become more evident in the coming week or two. Once we've cleared this clump of ink, and I don't mean you have to get back above 120, okay, but you get up probably in the mid-90s, and a lot of people are going to start to realize that, it's over.
If this continues for another quarter, retirement purchasing power erosion accelerates beneath stable account balances. What Michael Oliver is highlighting is how false breakdowns frequently flush retail positioning before institutional accumulation resumes. Silver briefly violated support, reversed within hours, then recovered while broader bond market stress quietly intensified underneath. Public narratives framed the move as panic liquidation, even while momentum internals signaled underlying demand returning aggressively afterward. Investors relying entirely on conventional diversification remain vulnerable if debt markets lose credibility faster than expected. Next, Michael Oliver unravels why stop-running events often conceal deeper institutional accumulation behavior.
It's going back up. Okay. Momentum says that's likely to happen now, that we're in that process. And we're not going to go sideways for another 3 months or go down to $50 or whatever, all the commentators say. So that's our assessment of silver right now. And it is leading. Back in November, it broke out silver price relative to gold when we plot it on a spread basis over a 10-year wide range of readings where silver would do this versus gold. And so when you plotted it, it would be capped off at a certain level, a very low level, by the way, silver versus gold. You broke through in November, and the sharp pullback we've seen since then in price really hasn't even dented that relative performance shift of silver versus gold. So that spread still tells us that the leader on the upside now, gold's important because it's the mama market, but will be silver and likely silver miners. So that's my heavy emphasis right now. There's another possibility, and by the way, there is another asset category that we wholeheartedly endorse, okay? And that's the commodity asset category, broadly speaking, okay? Commodities measured, let's say, by the Bloomberg Commodity Index, for example, are cheap in relation to their old highs. There's their own historic price history. They're cheap in relation to the stock market. In fact, they're off the page cheap. So when you look at a spread chart of Bloomberg versus the S&P, go back a couple decades, you look at the spread chart and think, what's it going to do? Go to zero? Commodities going to go to zero? No, they're a major buy.
Large institutions repositioned quietly, while retail investors focused mainly on short-term commodity volatility headlines. This is where Michael Oliver's thesis shifts from price action toward relative strength leadership across hard assets. Silver outperformed gold despite sharp pullbacks, where commodity valuations remained historically compressed against inflated equity market multiples. Policymakers promoted economic resilience even as capital slowly rotated toward tangible assets and resource-linked sectors underneath. Portfolios concentrated solely in financial assets may underperform if commodities begin repricing against weakening sovereign debt confidence. Next, Michael Oliver reveals why commodity leadership often emerges before broader market instability becomes obvious.
They've been basing versus the stock market in terms of relative performance. The net trend of the commodity complex turned up in October, well before the war event, okay? And I'm talking about, the grains, base metals, and oil was a laggard. Our buy signal on oil came in January. West Texas Intermediate crossed through 60, closed at 65 that month. We turned major bullish. Well, month and a half later, the war begins and suddenly you're up to 117. Well, anybody who bought that rally in oil is going to get gut kicked. I think you get back down to low 80s again, or maybe even high 70s. It is a major bull trend, but that news exaggerated that new trend. And likely that anybody who bought and chased that headline will find all their profits gone. Not the guy who bought it at 65 when we said to buy it there. But overall, the Bloomberg Commodity Index looks like a place that no leverage, just look at the commodity complex and stocks that are related to it, like oil stocks, base metal miners, ag-related stocks. And I think you can go along that sector and walk away for a couple of years, and it's going to go up on a relative basis, but also on a net price basis. So that's one category that I think will coattail gold, where money will flow.
With respect to any of your price projections here, are they dependent on the war continuing or they're becoming a peace deal? Your perspective on that, because it seems like we have been seeing, kind of a whiplashing market every time that Trump speaks or whatnot.
The Fed says conditions are stable, but commodity markets already rejected that narrative months ago. Michael Oliver notes institutional money rotated into hard assets before geopolitical headlines accelerated public participation and speculation. Commodity indexes strengthened against equities in October, while oil triggered bullish momentum signals before war-related volatility emerged globally. Public commentary blamed conflict alone, even though underlying capital flows had already shifted toward resource exposure beforehand. Savers chasing headline spikes instead of structural positioning risk, entering markets precisely when institutional traders reduce exposure. Next, Michael Oliver exposes why commodity leadership emerged before geopolitical stress dominated financial headlines.
I had a new headline to go up or down. Yeah. No, but net on balance, silver right now, since the beginning of that war, was in the upper 80s. Right now, we're 81, 82 today, okay? It was at 61. Well, has the war gotten better since late March? No, not really. And yet silver's back up to a level where it's sort of like if you shorted the war news, your best break even, maybe you're losing. And if you shorted the stock market based on, quote, war news, you're losing. So I think the war news is transient. Once it's over, that's when I suspect the stock market could get gut kicked or start to, because everything will be happy then, right? Hey, everything's good, therefore the sky is clear. That's when markets surprise, is when everything looks great and yet it doesn't behave that way. And I think that's the war news is has been a trap for a lot of traders, either side of either market. And I think the monetary metals are weathered it well. Anybody who bought them based on the global uncertainty issue got gut kicked, so they learned a lesson, hopefully. But the ongoing problem, again, is we don't have a mortgage crisis like 2007 and 9. We got a U.S. government and a Japanese government bond crisis, far bigger than any market out there. And the only way for the government to handle it, they can't quickly change the government spending in relation to the GDP, et cetera. That's not going to change quickly. But the Fed can come in with a fire hose and attempt to quell things. In fact, back in November, Williams, head of the New York Fed, said that the Fed was going to start buying bonds.
Nobody's discussing sovereign bond instability, and that silence itself is becoming the larger macro signal. According to Michael Oliver, war headlines distracted traders, while deeper monetary stress continued building beneath global debt markets. Silver recovered sharply despite ongoing geopolitical uncertainty, while bond markets kept deteriorating under rising refinancing pressure and liquidity concerns. Officials frame volatility as temporary, even as central banks prepared additional intervention tools and emergency liquidity responses behind closed doors. Retirement savers relying on nominal asset growth remain exposed if bond market credibility weakens faster than policymakers anticipate. Next, Michael Oliver reveals why liquidity injections may accelerate precious metals demand unexpectedly.
Okay. Well, if they did, and they did presumably, look at a price chart of bonds where they were then. They were 117 to 118. And yes, the decline has been slow, but it's been a steady decline. They've not been able to stop that market from going down, from yields from pressing up. So once they turn on the fire hose, where's that monetary flow going to go? If the investor public perceives the stock market category and the T-bond market is not a place to put that liquidity flow, where are they going to put it? In their bank account? Some will. That means in dollars, which are decaying. Probably in gold and silver. But at that point, we'll be in the accelerated phase of this overall trend that's been underway for a couple of years. And you'll be chasing the market. And you could see a lot get done in a matter of several months. And again, it would not surprise me, and I do expect to see 300 to 500 probably by this summer. Now, that seems ludicrous. There have been plenty of markets that have done that in the past. Copper did it in 2005 and 6, where it lived in a range for like multiple decades between 50 cents and $1.50, back and forth, boring. In late 2005, it popped up through $1.50. On its own, there was no other market impulse. It wasn't like gold was exploding then and it was on the coattail. It was on its own. And it tripled in price in a matter of several quarters. Went up to $4 versus its average price, which has been $1 for multiple decades. Lead did the same thing in 2007.
This happened before prior commodity repricing phases too, and policymakers ignored the early bond deterioration signs. What Michael Oliver is highlighting is the failure of liquidity interventions to stabilize long-duration sovereign debt markets globally. Bond prices kept sliding despite central bank support expectations, while yields continued climbing beneath optimistic economic messaging and forecasts. Public confidence still leans toward equities even as institutional capital increasingly questions traditional debt market safety and liquidity. Portfolios without hard asset exposure may struggle if monetary expansion accelerates, while bond purchasing power continues eroding steadily. Next, Michael Oliver unravels why historical commodity breakouts followed failed sovereign debt stabilization attempts.
Look at a lead chart. What the heck happened there? It was like a nuclear event. It just left the page on its own. Silver's in the process of doing that same thing. And so we suggest if you're not already long at the appropriate levels, which were mostly last year, in fact, they were last year in 2024 were our signals, then you better consider getting long now, because if this thing starts to scoot out of here, it is not going to go up in a staircasing manner. And much of it, by the way, could occur well before you ever get to a point where the stock market might be ready for a precipitous drop. Because I don't think the stock market's going to have a precipitous drop until you get into next quarter, maybe. Well, where's silver going to be by then?
If this continues for another cycle, delayed positioning could permanently damage retirement purchasing power and optionality. This is where Michael Oliver's thesis shifts toward historical commodity accelerations occurring before broader financial market recognition emerges. Previous metals and industrial commodities exited decade-long ranges rapidly once institutional flows overwhelmed available market liquidity supply. Mainstream narratives still frame metals as speculative despite persistent sovereign debt stress and expanding central bank intervention mechanisms. Savers waiting for official confirmation may face substantially higher entry costs after institutional positioning already matures further,